Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. One thing I like to go over is every single month when it ends, in the beginning of the next month, I like to go over real estate data. That real estate data is important for a robust housing market. A robust housing market is really what drives a leveraging up and a deleveraging or deflation on the back end when we have a housing crash. Right now, where I am predicting where we are is we're entering from a recovery phase into an expansion phase. We're right kind of in between that area where we're just starting to enter into an expansion phase. And that is where home prices appreciate the most. This is the lowest risk time to own real estate within the real estate cycle. Because what happens is your inventory, you start with a lot of inventory at the hyper bubble phase. You go into a recession. In that recovery phase, you work off the inventory. And right when you swap over from the recovery phase to expansion phase, your housing starts to go up. And they go into an expansion phase, which is above the yearly average for new homes being built. That's about 1.4 million-ish. We're at about 1.68 million-ish on the new housing starts. So we're just barely getting into an expansion phase. And now what I've got pulled up is the September 2021 data. And usually they release it in the beginning of October. And I've been looking at the data. I know we have a lot of people on YouTube. They think we're in this big bubble. I think there were some people, I think it was like something Ninja, Economic Ninja or something like that. He was calling a top in the real estate market. And we've got this other guy, top in the real estate market. And they got all this data. Well, I'll show you the data that I'm looking at. I have no idea what they're looking at. But here's the data that I've got. And I'll give you my financial opinion on what the data is telling us. So here is the active listing count. And the active listing count, and the reason this is important is it's not just inventory. It's the active listing count, what is available to buy on the market. And as long as you keep the active listing count, if this continues to go down, it means that your active listing count or inventory is tightening. It's not loosening up. We have record low active listing counts, all-time lows of active listing counts. Geez, this is hard to say. And September, we are still far below 2020, and 2020 had ridiculously low inventories. So you can see over time, 2016, 17, 18, 19, 20, and 2021, that our inventory is continuing to decline and get tighter. Having tighter inventory or lower active listing counts is not a sign of one, of a bubble, and of two, of the market loosening up, of the market weakening. This market is red hot and we have no homes to sell. Our inventory is depleted. And we've continually, year over year, have tightened up the entire time. So what's going to happen here? And this is just the active listings behind me. This is one metric. Is that people are going to continue to pile into the market and there's going to be no homes. There's no homes to buy. Prices are going to go up. They're going to go up and up and up and up and up and up and up. There is seasonality. And if you look at the curve here, this curve, it comes up and then it declines. It's seasonal. The inventory is seasonal. So the active listing count goes up and then it declines over time. And it goes over and over. And you can see the seasonality in this move. It doesn't mean that if this goes up from May, June, July, and August, that it's any different from any other years. So if these guys on all these other YouTube channels, they're saying, oh, the active listing count, it's going up, we're at a peak. If they don't know seasonality, they shouldn't have a channel, and they should not be talking about real estate in any way to help people out as an investor. There's seasonality here. It cycles up and down. And we're at the lowest it's ever been on a seasonal basis from September of any year, of any of this September month, in any single year, probably ever, we've never had active listing counts this low, especially in relationship to how many buyers are out there. So that's one thing I'll say. Going on down, we have newly listed homes, and this just means that how many homes are being listed. This is kind of the average, and we're trying to get back up to the average. If we get closer to this average and your active listing count stays low, all that means is that your home sales are going through the roof. That's what it means. It means that you can put more homes on and everything's selling that goes out. So anything that comes into inventory, it just all goes. And I think what's going to happen is new homes they're going to be built and they're going to be at higher prices because of inflation. It's going to drag the entire real estate market higher. If you want a new house, you got to pay, I'm going to make up numbers here, okay? Let's say it's $500,000 for a new house. Next year it's $600,000. Next year it's $700,000. And what people are going to do is they're going to say, that's too expensive, I'm going to buy an existing home. So it raises the demand on the existing homes, and it's going to raise the price of existing homes out in the market with new home prices going up with the inflation. Because your input costs are going to go up, your energy costs are going up, your lumber is going to go up, your steel is going up, all these things, concrete, up. That's what the energy crisis is going to do. So we've got newly listed homes. They're even if this tracks up, your active listing count's going down. So we're seeing a trend here where inventories are being depleted, even if our newly listed homes are going up a little bit. And this is your days on the market. This is how fast inventory is turning. And again, we are continuing to go lower and lower and lower year over year. 2020 was here where we had a little bit of a hiccup, obviously because of COVID. And then we came back down, and then 2021 super low. The trend was in place before COVID, because you can see that 2016 was here, 17 was lower, 18 was lower, 19 was about the same, and then 2020 was getting all out of whack, and then 2021 is far lower. But the trend over time for days on the market is continually to go down. So what happens is you have a group of inventory. As that depletes and goes down and becomes smaller, you have more and more buyers being active and bidding after less and less homes. So your active listings are going down, and now everyone's being competitive and going after whatever's left. It's basically throw something in the water and it looks like these little fish just gobble up whatever you throw in there. It's like feeding a bunch of fish in a lake and they just eat it the second you put it in the water. It's the same thing as these homes. You throw it out there and somebody gobbles it up super quick. So the metrics are all screaming that this market's going to continue on its trajectory. Is it going to go and have the same exact home price appreciation as before? I don't know. It's going to be probably a pretty good price appreciation. We have to build far more homes, period. Far, far more homes. We have a massive shortage. Things don't just work themselves out. You have to build homes, add it into the inventory, and slow this demand down. And if we have to build new homes in this inflationary environment, I would suspect that home prices are going to go up quite a bit, and that existing homes are going to be dragged up with it. So I think the whole market is going up higher. That's what I think. Because of these metrics. I have to see these metrics change in order for the housing market to go down. I have to see them change. You can't have a housing market that's turning its inventory rapidly and has no inventory out there and have the prices go way down. What this is doing, and for me to explain this in simple terms, homes are too affordable. We need these metrics to go in the opposite direction than what they are and make them far less affordable. And why do I say that? Because there's too many people going after not enough homes. So homes have to become less affordable to balance the market out. There just isn't enough homes to go around. So what happens is everyone who's on the bottom 50% or bottom 75% that can buy homes, they got to be priced out of the market. It's only those with the highest dollars that can get the homes. I don't determine the market. That's just the way the market functions. So when you put a house out there and you get 20 or 30 bids on it, a lot of people are going to be priced out. That if you get 20 bids, 19 people have to get priced out of that house until we get more homes that you can bid on. And that's just the function of markets. Now, if you know this data, if you know that the days in the market is only 11 days, and you know that your active listing counts is at all-time lows, what do you think the median price of homes are going to do? They're going to go up. That's what my opinion is. So I bet you that we went up in median listing price. And look at this. We went up substantially in median listing price over 2020 of September versus September. So what people are looking at is they're looking at this peak here and they're saying, oh, we're going down. It's a top. Well, not necessarily. We are also, if you look at some of these, and historically, like in 2019 peaked in May, June, July. That was the peak. And that's exactly what we have here. May, June, and a late peak in July. And we're coming back down for seasonality, which is very common in homes. They either stay flat or they decline a little bit for the seasonality. And we're coming up into that seasonality, and we're probably going to remain flat or decline a little bit in the median listing price. And it's up 8.6% year over year in September of 2021 over last year. You can see the big gaps, the big jump ups year over year of every single year. Home prices have been going up. And this is the price reduced share. So what percentage is reducing their prices? And this has gone up. So home buyers are being a little bit more picky. And some of the homes have to reduce their prices, or the seasonality is a little bit bigger. The market's finding its balance more so. And a normal market is probably at about 21, somewhere in this 21% range. And we're coming back and trying to get back more towards a normal market for the price reduced share. But we are still at very high appreciation rates. We are still at very fast days on the market to move. And we are still at very low inventories. Nothing's changed on that front, really. So I don't think anything's going to change in the housing market. Now, what would change my viewpoint where I would get bearish on the housing market? If we see a ton of foreclosures come on, if we see inventory and this active listing count go way up past 2016 here, which is this upper line. If we go past this line up here, then I would be like, okay, we're adding some inventory. That we're adding a lot of inventory. If I start seeing the median home price slow down, if I start to see the days on the market get back to 40, 50, 60 days, I mean, we are so far from that. Then I would start saying, you know what, we're probably slowing down here. We're going to slow down and come back more towards a normal market. We're in a white hot market right now, and I don't see it slowing down yet because of this data. I am going to continue to go over this data whenever it comes out, month after, every month. Share it with everyone on the channel. This is your driver. This drives inflation. This is going to drive interest rates higher. And if they continue to buy down interest rates, that's up to the government, but this is going to be a pressure and a force to drive rates higher. So I want to cover it. Everything looks good on this front. If this looks good, I don't think we're going to see a crash. I don't think we're going to see an overall market crash where everything gets completely destroyed. Will things go down? Yes. There's going to be normal market fluctuations. We could see stocks pull back if interest rates go up. But I don't think we're going to see a full-on market crash, because this is what supports a market. And if we're going to see a crash, we would see massive inventory levels, high days on the market, high interest rates, high home prices, high foreclosure rates. And it takes years for this to turn around. It doesn't take a month or two. If you guys like this content, give me a thumbs up. Subscribe to the channel if you haven't already. And thank you for listening. This is Finding Value.